It's Sunday night, January 18th, 2026, just past midnight on the West Coast. I've been staring at these screens for the last 18 hours, and I need you to understand something right now. What happened this weekend isn't a market event. It's a geopolitical earthquake that just shattered the foundation of the entire Western financial system. While you were watching football, while the mainstream media was running segments about tech stocks and consumer spending, President Trump dropped a bomb that sent gold to $4,690 an ounce and silver past $94 for the first time in human history. And I'm not talking about the paper price. I'm talking about the real price. The price you actually pay when you walk into a dealer and try to buy physical metal. That price just hit $130 in Tokyo, 80% premiums. The screen is lying to you. It has been lying for weeks. But after this weekend, the lie is so big that even the mainstream media can't ignore it anymore. I'm a private commodities analyst. I've been stacking physical silver and trading these markets for 12 years. I built this channel using an AI avatar for one reason: speed. I got tired of waiting half a day for the financial press to catch up to what I was already seeing on my terminal. And frankly, I got tired of watching all these other AI avatar channels pump out recycled hype and fake news about silver when there are real people out there, stackers and holders and retail investors like you, who need actual information to make decisions. Not clickbait, not entertainment, intel. So here's what happened. On Saturday, January 17th, President Trump posted on Truth Social that he was imposing a 10% tariff on all goods from Denmark, Norway, Sweden, France, Germany, the United Kingdom, the Netherlands, and Finland, effective February 1st, escalating to 25% on June 1st if there's no deal. And the deal he wants? The complete and total purchase of Greenland. Let me say that again. The President of the United States just declared economic war on 8 NATO allies because they won't sell him an island. And if you think this is just political theater, if you think the markets will shrug this off by Monday morning, you haven't looked at the gold chart. You haven't seen what happened to silver overnight in the Asian session. You haven't understood that we're watching the beginning of the end of the post-World War II financial architecture. Here's my claim, and I'm going to spend the next hour proving it to you with data and math and market mechanics that the talking heads on CNBC won't touch. The Greenland tariff crisis, combined with a criminal investigation into Federal Reserve Chair Jerome Powell, combined with the European Union's €93 billion retaliation package, has triggered the largest safe haven flight in modern financial history. Gold and silver aren't rallying. They're being repriced, and the repricing has only just begun. Let me give you the hard data. The snapshot I pulled a few hours ago. Gold spot price, $4,683. That's after hitting an intraday all-time high of $4,690.75 on January 18th. A single-day gain of over $62. Silver closed at $94.21, up over 31% year to date. And here's the number that should terrify anyone still holding paper contracts. The gold to silver ratio has collapsed to 50 to 1. That's the lowest level since 2012. For context, that ratio was at 105 to 1 in April of 2025. When the ratio moves like that, when it compresses this fast, you're not in a normal bull market anymore. You're in a structural reset. Now, let me teach you why the Greenland situation matters so much more than the media is letting on. This isn't about an island. This is about the complete breakdown of the Western alliance system. For 75 years, NATO has been built on a simple premise. The United States provides security guarantees to its European allies, and in exchange, those allies align with American interests and hold their reserves in dollars. That's the deal. That's the foundation. And Trump just took a sledgehammer to it. Think about what he's saying. He's telling Denmark, a NATO ally that has fought alongside American troops in Afghanistan, that if they don't sell him their territory, he's going to crush their economy with tariffs. He's telling 7 other NATO allies that if they dare to support Denmark, they get hit too. And here's the part that should send chills down your spine. Danish Prime Minister Mette Frederiksen said it out loud. She said, if the United States opts to militarily attack another NATO nation, then everything halts, including our NATO. She's not being dramatic. She's stating the obvious. If America attacks Denmark over Greenland, Article 5 becomes meaningless. The entire alliance collapses. And if NATO collapses, what happens to the dollar's reserve currency status? What happens to the assumption that American debt is the safest asset in the world? The market is answering that question right now. Gold hit its 70th record high in the last 18 months. Central banks bought 45 tons of gold in November alone, bringing year-to-date purchases to 297 tons. And the projections for 2026? JP Morgan says 755 tons. Goldman Sachs says about the same. 95% of central banks surveyed by the World Gold Council say they expect to increase gold reserves over the next 12 months. These aren't speculators. These aren't retail traders chasing momentum. These are the institutions that run the global monetary system, and they're all moving in the same direction, away from the dollar, into gold, But here's where it gets really interesting. While gold is up 70% year over year, silver is up 190%. Silver is outperforming gold by nearly 3 to 1. That's the kind of ratio compression that historically only happens during the parabolic phase of a precious metals cycle. And if you understand the mechanism driving this, you'll understand why the paper price you see on your screen has absolutely no connection to what's actually happening in the physical market. Let me break down the premium gap for you, because this is critical. The spot price for silver right now is somewhere around $85 on the COMEX and LBMA. That's the paper price. That's the number they flash on CNBC. But if you try to buy an American Silver Eagle from a major dealer in the United States, you're paying over $100. Some dealers are charging $107. That's a 17 to 25% premium over spot. And if you think that's bad, look at what's happening in Asia. Tokyo and Dubai are seeing physical silver premiums of 80%. That means if spot says 75, you're paying $135 to get metal in hand. The paper market and the physical market have completely decoupled. They're no longer even pretending to track each other. Here's the analogy I want you to think about. Imagine there's a concert and the face value of tickets is $85. That's what it says on the venue website. But when you try to buy, the website says sold out. Every ticket is gone. Now you go outside to the scalpers and they want $135. The $85 price is a ghost. It's a fiction. It exists on paper, but not in reality. That's exactly where we are with silver right now. The COMEX is selling tickets to a concert they can't actually get you into. And the scalpers, the physical dealers, they're the only ones with actual seats. Now let me tell you why the decoupling is accelerating. On January 1st, China implemented new regulations requiring government licenses for silver exports. They've effectively turned off the tap to the West. China controls about 60% of global rare earth processing and around 20% of refined silver supply. If you want silver out of China, you now need Beijing's permission. Tesla CEO Elon Musk posted on X about this, saying silver is essential for numerous industrial applications, and this is not good. He's right. Silver goes into solar panels, electric vehicles, 5G infrastructure, medical devices, AI data centers. Demand is exploding while supply is being choked off at the source. Then there's the COMEX inventory situation. I was reading an analysis from a CFA I follow on LinkedIn. On January 7th alone, 3.25 million ounces were withdrawn from COMEX silver inventory with 0 ounces received. Zero. That's been the trend since October. The vaults are draining. And when HSBC's commodity analyst James Steele says there's been a large migration of physical silver from London vaults to New York vaults, that's not a sign of confidence. That's a sign of panic. Institutions are pulling their metal out of London because they don't trust the LBMA to deliver. And then, on January 13th, the US Mint suspended all sales of numismatic silver products. The sovereign mint of the world as reserve currency stopped selling silver because they couldn't price products amid extreme volatility. Translation? They can't source metal at prices that make sense. When the US Mint goes dark, when the scalpers are charging 80% premiums in Tokyo, when China is restricting exports, the paper price becomes meaningless. It's just a number on a screen that has no connection to physical reality. Now let me address the skeptics, because I know what some of you are thinking. You're thinking this is a speculative bubble. You're thinking hedge funds are piling into leveraged positions, and when they unwind, the price is going to crash. Here's why that argument doesn't hold water. The CFTC commitment of traders' data tells a completely different story. Between September and December 2025, silver prices rose 57.7%. You know what happened to hedge fund net long positions during that same period? They declined 41.8%. Total open interest on the COMEX fell 51%. The speculators are getting out, not piling in. This is not a bubble. This is a structural supply squeeze driven by physical demand that the paper market simply cannot satisfy. Let me give you another data point. The silver market has been in backwardation since October 2nd. For those who don't know, backwardation is when the spot price is higher than the futures price. In a normal market, the future is always more expensive than the present because of storage costs and opportunity cost of capital. When that relationship inverts, when people are willing to pay more for silver today than for delivery in 3 months, it's a desperation signal. It means the market is screaming for metal now because there's real doubt about whether metal will be available later. Now, let's connect this back to the Greenland crisis and the Powell investigation, because these aren't separate stories. They're the same story. They're both about the collapse of confidence in American institutional credibility. On January 11th, the Department of Justice announced a criminal investigation into Federal Reserve Chair Jerome Powell. They're looking at his 2024 congressional testimony and some office renovation expenditures. Now look, I don't know if Powell did anything wrong. That's not the point. The point is that no sitting Fed chair has ever faced criminal investigation. The mere existence of this probe destroys the fiction of Fed independence. Powell himself put out a video statement saying, "This is a pretext for Trump's efforts to pressure the Fed to lower interest rates and undermine its independence." He said it increases concerns over longer-term inflation risks because it could mean rates are reduced despite inflationary pressure. Think about what that means for the dollar. The whole reason the dollar has maintained reserve currency status is because foreign governments believe the Fed will protect the currency's value. They believe monetary policy is insulated from political pressure. But if the president can use the Department of Justice to threaten the Fed chair whenever he doesn't get the rate cuts he wants, that illusion is gone. And once that illusion is gone, why would any central bank hold reserves in a currency whose value can be manipulated for political convenience? Russia figured this out in 2022 when the West froze $300 billion of their reserves overnight. Now Russia holds 42% of its reserves in gold. That's the highest percentage since 1995. Their gold reserves hit $310 billion in November, up 57% year over year. China has added gold for 14 consecutive months. Poland bought 95 tons in 2025 and now holds 27% of reserves in gold. Brazil added 43 tons in Q4 alone. Kazakhstan added 49 tons. The BRICS nations are systematically replacing dollar reserves with gold. And Trump's behavior, threatening allies, investigating the Fed chair, these actions only accelerate that process. Here's the math that should keep you up at night. Central bank gold reserves globally are now valued at close to $4 trillion. That roughly matches foreign-held U.S. Treasury debt. For the first time in modern history, central banks hold as much gold as they hold American government bonds. That's not a coincidence. That's a deliberate rebalancing. And it's happening at record prices. These central banks are buying gold at $4,600 an ounce. They're not trying to time the market. They're making a strategic decision that gold is safer than dollars. Now let me run this stress test on where this could go. The Wall Street consensus for gold by year end is somewhere around $5,100. Goldman Sachs says $4,900. JP Morgan says over $5,000. Bank of America says $5,000. UBS says $5,400. But the outliers are what interest me. Jefferies has a target of $6,600. Ed Yardeni at Yardeni Research is projecting $6,000 this year and $10,000 by 2030. And if you think those numbers sound crazy, consider that gold has already gained 70% in 12 months. A continuation of 30 to 40% annual gains puts you at $10,000 by the end of the decade. For silver, the technical analysts I follow are calling for $106 by the end of Q1. Christopher Moylan at Technical Traders says we could hit that within weeks based on the parabolic setup and momentum indicators. But here's the thing. Physical silver is already trading above 100 in many markets. The paper price is lagging. If Shanghai and Tokyo are paying 20 to 80% premiums over COMEX, the real global price of silver is already 100 plus. The screen just hasn't caught up yet. Let me now walk you through the European Union's response, because this is where the trade war escalation becomes very real, very fast. EU ambassadors held an emergency meeting on January 18th to coordinate their counterstrike. They're preparing a €93 billion tariff package, that's $108 billion, targeting American agricultural products, heavy machinery, technology hardware, luxury goods, and aerospace components. This package kicks in automatically on February 6th, 6 days after Trump's tariffs take effect. But that's just option one. Option two is something called the anti-coercion instrument. The EU has never used it before, but they're considering deploying it now. This tool allows them to restrict American companies from EU public procurement tenders, limit US investment in strategic European sectors, impose banking and financial service restrictions, and curtail trade in digital services where America runs a huge surplus. The 8 targeted nations issued a joint statement saying they stand united in opposition to these unprecedented tariff threats that undermine decades of transatlantic cooperation. French President Macron called it economic blackmail. German Chancellor Scholz called it the most serious threat to NATO cohesion since the alliance was founded in 1949. And here's the wild card. 8 European nations just deployed military forces to Greenland in what they're calling Operation Arctic Endurance. France sent special forces. Germany sent Arctic warfare specialists. The UK sent Royal Marines. Norway, Sweden, Finland, Netherlands, they all sent troops. Trump responded by posting, NATO tell Denmark to get them out of here now. He called the deployment a very dangerous situation for the safety, security, and survival of our planet. Stop and think about that. The United States is demanding that NATO order a member state to withdraw forces from its own territory. This isn't normal diplomacy. This is coercion on a scale we haven't seen between allies since World War II. And here's why Greenland matters so much. It's not just about the military bases, though those are important. Patuffik Space Base hosts ballistic missile early warning systems that give 15 to 20 minutes of extra warning time for Russian ICBM launches. The GIUK gap, that's the Greenland-Iceland-UK gap, is critical for monitoring Russian submarines heading into the North Atlantic. Climate change is opening Arctic shipping routes that could reduce travel time between Asia and Europe by 40% compared to the Suez Canal. Control of Greenland gives you dominance over all of that. But there's another factor that almost nobody's talking about. Greenland sits on one of the largest rare earth deposits in the world, 36 million metric tons of light and heavy rare earths, plus massive reserves of lithium, zirconium, titanium, niobium, and tungsten. These are the critical minerals that go into everything from electric vehicles to fighter jets to smartphones. China currently controls 60 to 70% of global rare earth production and 85 to 90% of processing. If the US could develop Greenland's deposits, it would break Chinese dominance over these strategic materials. The problem is that Greenland's 57,000 residents, 90% of whom are indigenous Inuit, don't want to be bought. 89% oppose US acquisition. The Thule people remember being forcibly relocated in 1951 when America expanded its airbase. That historical trauma colors every conversation about American intentions. Now let me tell you about the historical parallel that everyone keeps bringing up. The Hunt brothers in 1980. You're going to hear this comparison constantly over the next few weeks as silver pushes toward $100. So you need to understand both the similarities and the crucial differences. In 1979 and 1980, Nelson Bunker Hunt and William Herbert Hunt tried to corner the silver market. They accumulated an estimated 150 million ounces, nearly half of the world's deliverable supply. Silver went from $10 an ounce in the summer of 1979 to $49.45 on January 21st, 1980. Then, the exchanges implemented emergency rules. They banned new long positions, raised margin requirements, required 100% cash for new purchases. Silver crashed from 49 to 11 in a matter of weeks. The Hunts went bankrupt. They were eventually convicted of market manipulation. Here's why 2026 is fundamentally different. In 1980, the buying was concentrated in 2 billionaire speculators using massive leverage. In 2026, the buying is decentralized across central banks, sovereign wealth funds, institutional investors, industrial users, and millions of retail stackers across dozens of countries. In 1980, the motivation was pure speculation and an attempt to corner the market. In 2026, it's a safe haven flight from currency debasement, strategic industrial demand, and supply chain security concerns. In 1980, the Hunts were leveraged to the hilt and vulnerable to margin calls. In 2026, COTI data shows leverage has actually decreased during the rally. This is not speculative excess, it's physical accumulation. And here's the critical question. Could regulators implement another Silver Rule 7 and crush this rally like they did in 1980? Theoretically, yes. The COMEX can raise margin requirements. They can implement position limits, they've done it before. But the practical obstacles are enormous. The demand is globally dispersed, not concentrated in one entity. Chinese export controls have already reduced available supply. Many buyers are sovereign entities beyond US jurisdiction. Restricting COMEX alone would just accelerate price discovery moving to Shanghai, where China would gain even more influence over silver pricing. And politically, can you imagine the optics of the government restricting silver purchases to protect big bank short sellers against retail investors and central banks? That would be political suicide. Now let me give you my personal battle plan, because I know that's what some of you are here for. And I want to be very clear. I am not your financial advisor. I'm a guy who's been watching these markets for 12 years, and I'm telling you what I see and what I'm doing about it. You need to make your own decisions. Here's what I'm watching. First, the 5,200 level on gold. If gold holds above 5,200 for 3 consecutive daily closes, I'm interpreting that as structural confirmation that the Greenland crisis has fundamentally repriced safe haven assets. At that point, I'm maintaining full exposure through physical and miners. Second, the gold to silver ratio. We're at 50 to 1 right now. If it breaks below 48, I believe we're entering the parabolic phase where silver starts dramatically outperforming gold. That's historically been the signal that retail is waking up, and the final leg of the move is underway. Third, the physical premium spread. Right now, we're at 17 to 25% for silver eagles at major dealers. If that spread widens to 40% or higher in the US market, I'm interpreting that as confirmation that the paper market has completely lost connection to physical reality. At that point, I'm ignoring the spot price entirely and focusing only on whether I can actually acquire metal. Fourth, the Davos meetings this week. Trump is speaking on January 22nd at the World Economic Forum. He'll be face-to-face with European leaders who have traveled to Switzerland specifically to confront him over Greenland. If there's any hint of de-escalation, any face-saving compromise, we could see a 5 to 10% pullback in precious metals as risk-off positioning unwinds. I'm not selling into that pullback. I'm waiting for it. Because if it happens and the dip gets bought, that tells me the structural bid is even stronger than I thought. Here's my conditional strategy. If the EU implements its €93 billion tariff package on February 6th, and gold holds above 4,500 through the volatility, I'm adding to my minor positions. The miners have historically offered 2-to-1 leverage on the metal price, and right now they're still playing catch-up. Vaneka's analysis says gold stocks remain at historically low valuations despite triple-digit gains in 2025. That's where the asymmetry is. If the Powell investigation results in actual criminal charges being filed, not just an investigation, but formal charges, I'm moving 20% of liquid assets into physical gold and silver regardless of premium. At that point, we're in uncharted territory. The Fed's credibility would be destroyed. The dollar would face an existential crisis. And the rush into hard assets would make what we've seen so far look like a warm-up. If the COMEX or LBMA announces cash settlement for delivery requests, if they say we can't deliver the metal, so here's the dollar equivalent, that's the moment I stop looking at the paper price entirely. It means the fractional reserve bullion banking system has officially failed. It means the only price that matters is what you can physically acquire. And that price could gap up 30 or 50% overnight while the paper price collapses. Let me also address the bear case, because I want you to understand the risks. The most likely scenario for a pullback is diplomatic resolution of the Greenland crisis at Davos. If Trump and European leaders reach some face-saving deal where Greenland gets expanded autonomy with a neutral military status that satisfies U.S. security concerns, risk assets would rally, and gold could retrace to 4,200 or 4,400. Silver could give back gains to somewhere in the 70s or 80s. The second risk is a severe global recession. If the tariff war triggers a synchronized contraction that destroys industrial demand, silver would initially underperform gold. The ratio could spike back to 75 or 80 as silver's industrial demand component drags it down. But here's the thing. Even in that scenario, central banks would respond with massive stimulus. They'd print, they'd cut rates, they'd run deficits. And all of that is ultimately bullish for gold and silver after the initial panic subsides. The third risk is a dollar rally. If the DXY, which is currently around 99, somehow rebounds to 105 or 110, that would put pressure on commodities across the board. But I don't see how that happens given the fiscal situation. U.S. federal debt is past $36 trillion. Interest payments alone exceed $1 trillion annually. There's no credible path to fiscal consolidation. The dollar's structural supports are eroding. Now let me tell you what I think the real endgame looks like here. We're witnessing the early stages of a regime change in global finance. The dollar has been the world's primary reserve currency since 1944. That's 82 years. Before that, it was the British pound sterling. And the pound's decline took about 50 years from start to finish, first slowly, then suddenly. The forces driving de-dollarization are not going away. Central banks are diversifying at record pace. BRICS nations are building alternative payment systems. China's cross-border interbank payment system is gaining traction as a swift alternative. The digital yuan is already handling $250 billion in transactions. Saudi Arabia, which used to price all its oil in dollars, is now considering yuan settlements. The petrodollar system that's underpinned American financial hegemony since the 1970s is cracking. Gold and silver at current prices are not a bubble. They're a repricing event. They reflect diminished confidence in the dollar's long-term purchasing power and America's institutional stability. When the president threatens military action against allies for territorial acquisition, when the Department of Justice investigates the Fed chair for political reasons, when 8 NATO nations deploy troops to defend one of their own against American coercion, the premise of American leadership is being challenged in ways we haven't seen since World War II. I don't know if we're heading for a managed multipolar transition where the dollar gradually declines from 60% to 40% of global reserves over a decade or two, or a disorderly collapse where some crisis triggers rapid dollar dumping and gold goes to 8 or 10,000. Or a bifurcated system where the Western Bloc uses dollars and the Eastern Bloc uses yuan and gold and they partially decouple. But in all 3 scenarios, being positioned in hard assets is the right call. The only losing scenario is staying 100% in dollar-denominated paper and watching purchasing power erode. Here's my 3-sentence recap. Trump's Greenland tariff ultimatum has triggered the largest safe haven flight in modern financial history, sending gold to $46.90 and silver past $94. The physical market has completely decoupled from paper, with premiums hitting 80% in Asian markets while COMEX vaults drain and the U.S. Mint suspend sales. Central banks are buying gold at record prices because they no longer trust American institutional stability, and the Powell investigation just confirmed their fears. The math is clear. The setup is there. The screens are lying, but the vaults don't lie, and the vaults are emptying. Now let me leave you with this. I know some of you are going to watch this video and do nothing. You're going to think about it, agree with the thesis, and then get distracted by life. And in 3 months, you're going to see gold at 5,500 or 6,000 and silver at 120, and you're going to kick yourself for not acting when you had the chance. Don't be that person. If you believe the thesis, position accordingly, even if it's a small position. Even if it's 10% of your portfolio, do something, because the regret of missing an opportunity is worse than the regret of taking a small loss. The World Economic Forum in Davos starts tomorrow. Trump speaks Wednesday. The EU tariffs kick in February 6th. The next 3 weeks are going to be some of the most volatile in precious metals history. I'll be monitoring the situation in real time. If something major breaks, if we get the move I'm expecting, I'll be back with an update. Until then, stay sharp, stay disciplined, and don't let the mainstream narrative distract you from what's actually happening in the physical market. The opportunity is right in front of you. The data is undeniable. Now we just have to see if the world catches up to what we already know. I'll see you in the next one.